Hey, look, when you retire, certain taxes, hey, they just go away. For example, you no longer will be paying payroll taxes such as FICA and Medicare as long as you're not working and you're receiving a paycheck. But there are other taxes that you may pay that could affect your retirement. My name is Keith Wilson, and I am a financial advisor helping folks just like you implement tax-efficient strategies in retirement. And in this video, I will be showing you various taxes you may face and some ways to help minimize taxes in retirement. Lightning strikes and then you're gonna know my name. All right, first of all, let me just be clear. This is not tax advice, just merely things to consider when it comes to taxes in retirement. Now, with that, let's dive in to various tax situations you may encounter in retirement. First of all, your Social Security benefits. Social Security benefits could be taxed anywhere from 0% all the way up to 85%. To determine if benefits are taxable, what you do is take half of the Social Security money you collected during the year and add it to your other income. Now, other income includes things like pensions, wages, interest, dividends, and capital gains. So if you are single, and that total comes to between $25,000 and $34,000, then up to 50% of your Social Security benefits may be taxable or included in your taxable income. Now, if you're married, filing jointly, then the threshold is between $32,000 and $44,000. If it's more than $34,000 for single taxpayers and more than $44,000 for married filing jointly, then up to 85% of your Social Security is included in your taxable income. Now, this calculation to determine how much of your Social Security benefit is taxable, it can be a little confusing. And I'll direct you to an IRS calculator that you can use that will help you. And what I'll do, I'll put a link to that calculator in the description below. Now, what you could do by delaying the start of Social Security benefits, that can increase the eventual benefit amount. And when you do start collecting that higher amount down the road, you may not need to withdraw as much from other sources, and thereby what you're doing is keeping you in that lower threshold amount. Now, that takes some planning, but it is a strategy to consider. Hey, look, you can check out a video where I discuss, timing of Social Security benefits right up here. Next up are IRA and 401k distributions. Money that you have contributed over the years to an IRA or 401k. It's never been taxed. What you did is you got a tax deduction when you made those contributions, and any growth throughout the years have not been taxed. That's great, but when you withdraw from those accounts, then that amount you withdraw is fully taxable to you at your ordinary income tax rate. And that depends on what tax bracket you are in. Hey, look, even if you don't need money from your IRA or 401k right now, when you turn 73, or if you turn 75 in 2033, you are forced to make a required minimum distribution, or RMD, and then that would be taxed at your ordinary income tax rate. For example, let's say you have $500,000 in your IRA. Then at 73, that RMD amount would be almost $19,000. A couple of strategies to think about here. One would be what is called a QCD, or Qualified Charitable Distribution. So if you are charitably inclined, then you can give your RMD amount to the charity of your choice, and it would not be taxed. Now, you could not write that off as a charitable donation, but again, you would avoid paying taxes on the RMD by giving it to charity. Some people do is start converting some of their IRA to a Roth IRA to help reduce the amount they hold in an IRA. Now, there's some rules to follow on Roth conversions, like you have to hold it for 5 years and be over 59 and a half before you can pull money out of the growth portion without being taxed or penalized. Hey, you may want to check out some videos I posted on Roth conversions. I post a lot on Roth conversions. And while you're at it, go ahead and subscribe to the channel. Give this video a thumbs up. I would really appreciate it. Look, I post a lot of content on retirement planning and personal finance you may be interested in. Okay, speaking of the Roth IRA, that's an easy one. Because when it comes to taxes in retirement, there is no tax when you withdraw from the Roth IRA, as long as those rules that I mentioned before were followed. That's why the Roth is a very popular account to hold. All right, next let's talk about interest income, like interest you earn on CDs or money markets or high-yield savings accounts. If you have these type of accounts that pay interest, then that is taxable to you at your ordinary tax rate. Now, people will say to me, hey, Keith, I don't withdraw any of that interest that I make on my CD or high-yield savings account. I just let it grow and compound. Do I still pay taxes on that even though it's reinvested? And the answer is yes, you do. You pay tax on the interest you earn in the year you earn it. Now, annuities are a little bit different. So unlike a CD where you pay taxes on the interest you earn in an annuity is tax deferred. You only pay taxes on that interest when you make a withdrawal. Now, I should back up and say that I'm referring to a non-qualified annuity, one that is not a retirement account. So, for example, let's say you put $100,000 into an annuity some years ago, and it grows to $200,000. Then you will pay tax on that growth portion when you pull it out at your ordinary income tax rate. And again, you only pay tax on the growth portion with that annuity because you already pay tax on the amount you originally put in. And when it comes time to withdraw, the growth portion comes out first. What about capital gains on your investment accounts? Well, they are taxed a little differently at what is called a capital gains tax. And the tax rate depends on how long you held that security in the account. If you held it more than 1 year, then it's considered a long-term capital gain, and it's going to be taxed at 0%, 15%, or 20%. Capital gains tax has its own bracket, not like ordinary income tax rate. So it has its own bracket, which I'm going to put up on the screen for you to see. So as you can see in the table, most people will fall in the 15% capital gains tax rate, which could be lower than the ordinary income tax rate. For some, they could pay 0% on capital gains. Now keep in mind, just because your investment account grew in value, that does not necessarily mean you pay taxes on that growth. You only pay a capital gains tax when it is what is called realized, meaning you actually sold a security for a gain and realized that gain. Now, if you sold a security and held it less than 1 year, then that is a short-term gain, and there is no 0% tax rate on that gain. So short-term gains are taxed at your ordinary income tax rate. Now, it's important to note that capital gains tax applies to your investment or brokerage account. That is not an IRA. IRA accounts do not have capital gains tax. You could buy and sell all day long, and capital gains would not be an issue in an IRA. It's only when you withdraw from an IRA that triggers a taxable event. Now let's talk about dividends in a non-IRA account. Dividends can be either qualified or ordinary dividends. Qualified dividends would be taxed at the same rate at the capital gains tax rate, which could be 0%, 15%, or 20%, depending on your income. Now, ordinary dividends would be taxed, well, at your ordinary income tax rate, depending on what your bracket is. Now, the next tax you may pay in retirement, it's really not a tax, really a surcharge. So what I'm talking about is if you are on Medicare, you pay a Medicare Part B premium each month. And there is a standard Part B premium, and it's usually deducted from your Social Security check. But if you are a high income earner, then that standard amount will be more, and it is on a sliding scale. This is called IRMA, I-R-M-A-A, or income-related monthly adjustment amount. So what will happen is Medicare will look back at your tax return from 2 years ago to determine if your Medicare premium will be higher than the standard amount. Now, there is a way to appeal this adjustment if you had a life-changing event like death of a spouse, or most commonly would be work stoppage. So think about this. Maybe you were still working and making a high income right before you go on Medicare, and then you retire. What happens is income is reduced. You could file for an adjustment based on the fact you will be earning less now that you are retired. All right, so there you have it, some things to consider about taxes in retirement. And look, I know it's a lot to think about, and it really comes down to where to pull the money from in a tax efficient way, and that takes planning. So I would advise you to get with your tax or financial advisor to discuss these strategies, and if we need to talk, check out the resources below. And until then, thanks for subscribing to the channel, and we'll see you next time.
If I don't know any limitations.